Morning, everybody. I'm very happy to welcome you to this first panel, which is on the theme of monetary policy and global financial cycles. We all know that financial conditions are heavily impacted by the global financial cycle. And the question arises, to what extent domestic policymakers still have control of their own financial conditions. Thomas's opening remarks pointed to the fact that, at least to some degree, of course, monetary policy still has control over financial conditions. But how far, to what degree does that go, right? I mean, of course, domestic policy can influence financial conditions, but how much can they influence it? And what are the policy implications from the observation that this global financial cycle is very important for countries around the world? This is, of course, especially important for small open economies, but I will show you some evidence that even for a country like the US, this is actually an important issue, an important consideration for policies. I will also show you that even housing prices, houses which are quintessentially non-traded assets, have become very much globally integrated, right? And so even for non-traded assets, it can be the case that the global financial cycle is the predominant determinant. So with that, I'm going to talk about three things. So first, about this nexus of global financial cycles and monetary policy. Secondly, I will talk a little bit about global capital flows and policies towards global capital flows. And then thirdly, I will talk about macroprudential policies. So what is the global financial cycle? There are different ways to measure it. The way that we look at it at the International Monetary Fund is typically through a global financial conditions index. So what we do to compute such an index is to use many asset prices for many countries around the world. We use around 40 countries around the world, both advanced economies and emerging markets. And we extract a common component out of all these asset prices. We also use some quantity-based indicators, such as credit to GDP and different metrics of leverage. And these are all put together into one index, and that index then is purged of macroeconomic data, so that we have a financial market signal that is, that is different from a basic economic index. And what you can see is sort of like a familiar story, which is that financial conditions were very easy in the run-up to the last financial crisis in 2005, 2006, 2007, with very easy financial conditions. And then financial conditions tightened extremely sharply as we went into the financial crisis. Since then, financial conditions have gradually eased over the past decade, and they're now at very, very easy conditions, with the caveat that in the past 2 months, first with the VIX tantrum in February, on February 5th, and then with all the negotiations about the trade, financial conditions have tightened a little bit, but they still remain fairly easy by historical standards. So they're still in the negative territory. So in this index, whenever you're in positive territory, you have tight financial conditions. Whenever you're negative, you have easy financial conditions. Now, why are financial conditions important? So one way to see the importance of financial conditions is to look at it in terms of the information content for future economic activity. So what we have introduced in October 2017 in the GFSR is the notion of GDP at risk, or growth at risk. So we are asking, to what extent do financial conditions signal downside risks to economic activity? So here we're looking at it at the global level, but of course you can do these types of combinations also at the country level. So we are asking, to what extent do financial conditions tell you something about the downside risks to GDP growth? And so the left chart shows you the conditional probability distribution of growth going forward 1 year in the future and 3 years into the future. And it shows you the current, as of 2018 Q1, the current conditional estimate of where global growth is going to be 1 year out and 3 years out. And basically what it tells you is that 1 year out, we estimate that the downside risk is very limited, right? The point estimate for growth 1 year out is 3.9%. That's from our World Economic Outlook. And the downside risk metric, here we use the value at risk of this distribution as downside risk. So the 5th percentile of this distribution is only 3%. So in a severely adverse scenario, our best guess for growth 1 year out, so growth over 2018, would be that instead of being the 3.9%, it could be perhaps 3%. So it's bad, but it's not that bad. Looking 3 years out, it looks much worse. So 3 years out, you see that the distribution is much more spread out, and the growth at risk, the 5th percentile of this distribution, is negative. And so the right-hand chart gives you the time series of this 5th percentile of the distribution 3 years out. So what is the growth in a severely adverse scenario 3 years out over time? And you can see that at the moment we are at a fairly, severely bad scenario by historical standards. So basically, the punchline here is that measures of financial conditions have a lot of information content for the future distribution of growth. And I think many central banks around the world are doing similar exercises at the moment to sort of like explore these kind of relationships. Now, what is more important for the discussion today is the question of how each individual country is related to the global financial cycle. What I'm showing you here are the average correlations of countries' financial conditions with the global financial conditions index. And you can see that there was a sharp rise in these average correlations between the mid-90s and the mid-2000s. Since then, we have leveled off. But we have leveled off at a very, very high level, right? So we went from roughly 50% to something like 90%. And since the global financial crisis, the correlation of individual country, the average correlation of country-specific financial conditions with the global financial cycle is between 80 and 90%. So that is the question. So to what extent are policymakers in charge of their own domestic financial conditions? We all believe that monetary policy impacts the real economy through its impact on financial conditions. So given these very high correlations, are domestic policymakers actually still in charge of their own financial conditions? That's the big question. To give you even more food for thought, this is a correlation, so it's the share of variance of house prices explained by a common global factor. So this is asking to what extent are housing prices across major countries and across major cities such as Zurich, it looks very, very similar actually. To what extent are these house prices moving together globally? And what you can see is a very striking fact. Compared to 30 years ago, housing correlations are 3 times higher today than they were, say, in the mid-1980s or early 1990s. The overall level is not quite as high as for the financial conditions, so the overall level is around 35%. But remember, these are non-tradable assets. Right? So for houses, quintessentially non-tradable assets, you see this massive run-up in the correlations across countries. So when you look across countries and you ask, okay, so here we're looking at the stock market in particular. So when the stock market of an individual country is more correlated with global financial conditions, what does that mean for the growth rate over a 30-year period? So this is the average over 30 years. So countries that are more exposed to the global financial cycle tend to grow more, but they also tend to have higher volatility. And here, this is a sample of countries of advanced economies and fairly advanced emerging markets, okay? So basically, when you're more exposed to the global financial cycle, you tend to grow more, but you're also more risky. So you tended to be hit harder in the global financial crisis in particular, right? And so there's a kind of a risk-return trade-off, right? So like participating more in global financial markets means that you have a benefit in terms of growth, but you also have a cost in terms of importing these global financial conditions into domestic financial conditions. So what does that mean for the policymaker? There's the classic answer from Mundell Fleming from back in the 1960s that was talking about the monetary trilemma. That's the classic, that's all like what we all learned in school. So the classic trilemma says that you cannot have monetary autonomy, free capital mobility, and fixed exchange rates at the same time. So since the 1960s, of course, the world has evolved towards more and more countries having flexible exchange rates, or to at least largely flexible exchange rates, some management of the exchange rate regime, but they're largely flexible. So we went from the gold standard to a regime with flexible exchange rates. And capital mobility is largely free. That's not true in every country. And so that, in principle, according to Mundell Fleming, assures that monetary policy is independent, right? Because exchange rates adjust, capital is more or less flowing freely, and that, in principle, should give you complete monetary autonomy. Now, there's a twist to that, and that really goes back to an important contribution by Hélène, the next speaker on the panel. In a 2013 Jackson Hole paper, Hélène said that we are no longer in a world of a trilemma, we are now in a world of a dilemma. And her rationale was to say that, look, because global financial conditions are more or less determining domestic financial conditions, no matter whether you have free floating exchange rates or flexible exchange rates, you still don't have monetary autonomy, right? So even with free floating exchange rates, you don't have monetary autonomy because basically your financial conditions are determined. So the only way for you to protect yourself against that is to basically have capital controls. And of course, we do see a number of countries around the world that do, to some extent, have capital controls and to some extent intervene in the foreign exchange market. Now, Maury Obstfeld, the economic counselor, my colleague at the IMF, he sort of, argued that, well, you still have a trilemma. It's all a matter of degree, right? So you don't have full monetary autonomy, but you have some monetary autonomy. And I think that resonates with what Thomas said in the opening remarks, right? So we do have the global financial conditions that is a constraint on domestic monetary policy, but it's not entirely making monetary policy independent. So basically, these considerations complicate the trade-off, but there still is a trilemma to some extent. And flexible exchange rates in general do help you to absorb shocks. So let's take a look at the evidence. So what we did here was to just ask, so we asked, to what extent are domestic financial conditions determined by global financial conditions? That's the red line, and the standard arrows are in dotted lines. So that's an impulse response function. The red is a shock to global financial conditions and the response of domestic financial conditions. And then we compare that with a shock to monetary policy, domestic monetary policy, and that's the green line. And so basically what you can see is that the magnitude of a shock to monetary policy is similar to a shock of global financial conditions. But, and that's the big challenge, monetary policy reacts more slowly than global financial conditions. So when you have a deterioration of global financial conditions, think about certain countries at the moment. Imagine you are the central bank governor of a certain country right now that has an adverse shock in terms of global financial conditions. What this is telling you is that you ultimately can offset it, but there's this lag, right? There's this lag of like 3 or 4 quarters. And so first of all, you have to understand what's happening, and then even if you do monetary policy, it's not going to be as quick as the global financial conditions. So that is a real challenge. So that, I think, is giving one particular answer to this debate about the trilemma versus the dilemma. It's like, yes, you can use monetary policy, but monetary policy is not quite as effective as actually global financial conditions are in terms of impacting domestic financial conditions. Now, let me look at one particular case study that is very interesting, in particular with respect to this debate. So many times, and here I'm putting Hélène a little bit on the spot, many times academics argue that global financial conditions are essentially US financial conditions, right? And so they use US financial conditions as a proxy to global financial conditions. I would argue this is not entirely right. And so the left-hand chart shows you that. So what I'm showing here are the 4 last tightening cycles in the US. Okay, so the dots are the tightening cycle in the late 90s. Sorry, this should be, the red one should be 99 to 2000. That's the 99 to 2000 tightening cycle. The yellow one is 2004 to 2006. The blue one is 93 to 94. And the green one is the present tightening cycle. Normally, in the previous 3 tightening cycles, what happened is that as the Federal Reserve increased the Fed funds rate, US domestic financial conditions also tightened. In the current cycle, that is not the case. In the current cycle, the Fed has started to tighten the Fed funds rate in December 2015, but US domestic financial conditions have eased during that time. And I would argue that is because global financial conditions have become easier and easier. So even for the US, you have this kind of constraint of global financial conditions. And so, on the right-hand chart, you also see that even the dollar has weakened. Even though the Fed has tightened, over that period, the dollar has actually weakened, and that actually has happened previously as well. So, even for the US, it might not be entirely true that the US is in charge of domestic financial conditions, but other countries are not. The US also faces such trade-offs. Now, when you again look across countries, and you look at a proxy for the conservatism of monetary policy, so you look on the slopes of the Taylor rule coefficient. So how aggressive is monetary policy in terms of reacting to the output gap and to inflation? What you can see is that those economies that are more aggressive, that are more conservative, tend to have lower loadings, lower correlation with the global financial cycle. So having more conservative monetary policy tends to make you a little bit more disjoint from the global financial cycle. So that is one hint as to how you can manage this dilemma, which is you follow traditional monetary policy very aggressively. So let me talk a little bit about capital flows next. You probably all know this particular stylized fact, but it's always interesting to remind yourself of it, which is that the red line is global GDP, the green line is global trade, and then the blue line are the global gross financial flows. And what you can clearly see is that the global gross flows are magnitudes, order of magnitudes larger than the underlying economic activity. So there are these massive gross flows that countries are exposed to. Now, when you look at these capital flows, and you ask to what extent are they driven by common factors. So here I'm looking at 3 common factors, like principal components of capital flows from advanced economies to emerging markets. What you can see is that particularly during times of stress, such as the global financial crisis, the taper tantrum, and the 2015 renminbi devaluation, during those times, these global capital flows, during those times of stress, these global capital flows are particularly correlated. So, you have like a 60%, the 3 common factors explain 60% of these capital flows across all of these different emerging markets. In general, 3 factors for the 2010 to 2017 period explain, close to 50% of global capital flows. So there's a very, very strong commonality in global capital flows. So that is sort of like the quantity-based equivalent to the Global Financial Conditions Index, which is primarily about asset prices. Now, what kind of policies should you undertake? So in the fund's view, exchange rate policies matter. And in general, we argue that exchange rates can act as a shock absorber for these gross capital flows. So exchange rate flexibility discourages unhedged FX borrowing by households and firms. It encourages the development of markets for FX hedging instruments, and floating exchange rates discourages dollarization of bank liabilities. In fact, you can show in the data, this is done by IMF authors, including Jonathan Ostry, who's here today, that floating exchange rates tend to be less susceptible to financial crisis. So countries that have floating exchanges tend to have less financial crisis. So in general, we argue that, yes, floating exchange rates are a shock absorber, and that is one important way to deal with all those capital inflows and outflows. Now, of course, as I mentioned earlier in my discussion, there are a number of countries that do not have fully open capital market accounts and that do intervene in foreign exchange markets. What is the IMF's view of these kind of policies? So what we have at the IMF is what is called the institutional view on capital flow measures. And so the capital flow measures include capital controls, but also include exchange rate interventions. And so basically in the institutional view, depending on the situation of the country, depending on whether the exchange rate is overvalued, reserves are adequate, or the economy is overheating, we recommend that countries do use domestic monetary policy together with possibly interventions, FX interventions, that might be sterilized in order to address those capital flows. And to some extent, we also say that capital flow measures such as capital controls can be temporarily be used by countries in order to address inflow surges and to some extent outflow surges. Now, the other important finding that we have documented in many studies is that macroprudential policies can also help with global capital flows. So there are many types of macroprudential policies. There are broad-based tools such as countercyclical capital buffers, leverage ratio caps, macroprudential stress tests. There are sectoral tools such as LTV ratios, DTI ratios, and sectoral capital requirements. There are liquidity tools such as the LCR, the NSFR, and then there are the structural macroprudential policies. And all of these macroprudential policy tools dampen the pro-cyclicality in the economy, and they build resilience against adverse developments, including adverse developments from capital flows. And so macroprudential policies essentially dampen pro-cyclicality, in particular of capital inflows. They're constraining the leverage cycle of the banking sector, and they're curbing excessive credit risk to local borrowers. And in times of capital outflows, they are making sure that banks and corporates have enough capital buffers to be hedged against the adverse effects of capital outflows. So in general, in our view, macroprudential policies can be effective in protecting countries against global capital flows, with the caveat that, of course, in the global context, macroprudential policies can be circumvented. And so there is some limit to the degree to which macroprudential policies are effective. And that, I think, is a great topic for discussion. I think different countries have different experiences in that regard. So let me conclude by just saying that global financial forces do worsen the policy trade-off for policymakers. And I've shown you evidence that this problem has become worse over the past 20 years with increased integration. There is more of a global component to domestic financial conditions that has to be taken into account in setting domestic policies. But I also show the evidence that in the end of the day, domestic policymakers still are, can influence domestic financial conditions. They just have to take into account that global financial conditions and global capital flows are important. In our view, macroprudential policies help in terms of developing the local investor base and building resilience against global financial shocks. And exchange rate flexibility helps, and to some extent, capital flow measures can also help. But clearly, the punchline is that for monetary policy, taking these global capital flows and the global financial conditions into account does seem very important. So with that, I will turn next to the first panelist, Hélène Ray from London Business School.
Thank you very much, Tobias, and many thanks for having me here today. It's a great pleasure and honor. So Tobias gave us a very nice description of global financial cycles. And indeed, back in 2013, I had similar definitions in terms of fluctuations in financial activity, whether measured by risk-taking, credit creation, asset prices, capital flows, or spreads on a global scale. So these are the attributes of global financial cycles. And I think there is also a growing body of evidence on the importance of global financial cycles. So I think we can see it in macroeconomic data. So in particular, for example, if one tests for the number of global factors in risky asset prices around the globe, one finds that there is one global factor that explains about a quarter of the variance of all risky asset prices across continents. Tobias showed this very nice evidence also on capital flows in stress times, where a large part of the variance was explained by global factor. I think we also have now more data, which is a little bit more on the microeconomic side, showing the importance of global financial cycles. So, for example, data on Turkey on credit bank registries, which shows that an amazing large part of local credit growth is actually explained by global capital flows. So I think there's a large body of evidence which is building up and pointing to the quantitative importance of these global financial cycles. Now, so one word on the dilemma versus trilemma debate. So I think we all agree here that exchange rate regimes are not equivalent. And I would totally agree with Tobias and Maury and Opsfeld and Jonathan that, for example, flexible rates would tend to decrease crisis probability. However, I think what is really important for policy as well is to really see that, and this is the essence of a dilemma, that flexible exchange rates are just not enough to lift the constraints that the global financial cycle puts on monetary policy. And as Tobias very nicely emphasized, there are lots of transmission channels through which global financial shocks affect monetary and financial conditions in domestic economies. So because of this multidimensionality, because of these heightened correlations that he showed between domestic financial cycles and global financial cycles, I think it's pretty clear that additional tools, besides the traditional monetary policy tools, are needed to regain some autonomy. And in particular, so here Tobias emphasized the capital flow management tools, but actually I would also really put forward the macroprudential tools, which are very important to regain some autonomy. Now, one of the key questions, maybe on which Tobias hasn't really I think that Tobias hasn't really emphasized is what is then, or what are the drivers of global financial cycles? And so here I would argue, based on some research, that one of the key drivers of global financial cycles is indeed US monetary policy, but by no means it is the only driver. So on this, I would totally again join you, Tobias. So here what I'm showing you on this graph is the response of banks leverage, not only in the US, so on the first panel you have the US broker-dealers, but also in the euro area, the globally systematically important banks, and the UK, also globally systematically important banks. So their response of their leverage to 100 basis points tightening of the effective Fed funds rate. Okay, so that's to a tightening of the Fed. And so you have on the vertical axis, these are percentage points, and on the horizontal axis, this is the time, so these are quarters. And you can see that the Fed has an effect on leverage, of course, at home, but also for the global banks of other areas. And they behave, in fact, quite similarly, these impulse responses. So if you look at this red line, for example, you see that the response is quite similar. Now, if we look at the reaction of global credit, so this is going to be credit excluding the United States, and also cross-border credit to banks and cross-border credit to non-banks. If we look at these impulse responses, again, following 100 basis points tightening of the Fed, you see that there is a very sizable effect, this is again in percentage points, of the US tightening on credit creation worldwide and cross-border credit flows. So this is statistically and economically quite significant. Now, if we look the last graph, which is the response of global asset prices. So this global factor that I explained, that I talked with you about before, which explained about a quarter of the total variance of global risky prices, of risky asset prices worldwide. So this global asset price factor also responds to US monetary policy tightening. So does aggregate risk aversion. So does excess bond premia. So there is notable responses of asset prices to US monetary policy tightening. So to sum up, I would not say, of course, that US monetary policy is the only driver of the global financial cycle, but I would say it is an important contributor. It is an important driver of global risk appetite. And there is a research network of central banks who has very recently done some meta-analysis of effects of foreign monetary policy on domestic lending, so in very many different jurisdictions, essentially running the same models on their own data. And most teams, so the conclusion of one of the conclusions of this joint research effort by many teams in different central banks is that most teams have identified significant effects of US monetary policy, that is on domestic lending, and some teams also found effects from Euro area, UK, and Japanese policy, okay, which is probably not in effect, that surprising given the size of these currency areas as well. So what do we do with these global financial cycles? So what can we do? So we have to remember, first of all, that crises are very often booms gone bust. So that really means that during boom times, we have to be especially careful, and that immediately ask the question, do we have the right early warning models? So the right early warning tools to identify early enough the bad booms, the ones which are going to end up in crisis. Now, it turns out that early warning models are quite unstable, the ones we have, because a lot of these variables, credit, leverage, etc., are indeed very highly correlated with one another. And we often tend to either overpredict crises or miss some crises. So I think we have two things, two promising directions there. One is to use more micro-level data, and in particular, intermediaries' balance sheets data, track better on which balance sheets the risk concentrates during boom times. So that's one venue where I think we can do a lot better. And another one is to use much more robust techniques for these early warning models, in particular using learning algorithms. And I think both these roads would give us better early warning models. Now, on the positive side, and this was also mentioned by Tobias, I think we have more and more evidence coming in that actually macroprudential policies or some macroprudential instruments tend to make a difference, tend to work. So that is good news. And finally, also in boom times, we should not forget about the role of fiscal policy, which can very, very importantly dampen the booms. And that's highly desirable. Now, what about busts? Well, first of all, I think the 2008 crisis that we have been living through had very many similarities with the Great Depression. And I've done some work with Pierre-Olivier Gouracha showing the parallel between the roaring 1920s and the exuberant 1990s, 2000s, with exuberant asset valuations in both cases, financial crisis, and then large busts with large economic costs. And in both cases, these large busts being caused in part by massive leverage. And I do think that one very plausible interpretation of our current low real rates environment is in both cases, and we saw also that after the Great Depression, is due to periods of deleveraging post-crisis. So post-Great Depression and post the 2008 crisis. Now, what does that mean for macroprudential policies? How can we deal with busts? Well, I think that means macroprudential policies can help reinforce expansionary monetary policy during busts, for example, by reducing countercyclical buffers. That assumes, of course, that at some point these buffers had been put up, or that by using other types of macroprudential policy tools which might have been tightened and that can be loosened. And there's also, again, an important role for monetary policy, for fiscal policy, evidently during bust time. So to conclude, what does that say about the current situation? Well, we might be at a time where global risk appetite may be about to decrease. Until now, I think, as pointed out by Tobias in his very nice graph on financial conditions, the Fed tightening might have been partly offset by the ECB, the Bank of Japan, and the dollar weakness. But this may not last. And as we have seen, a decrease in risk appetite has effects on risk premia, on volatility in general, also on credit creation. So when that happens in an environment of high debt, which is still our current environment, with potentially destabilizing balance sheet dynamics, I think that might lead to quite some risk materializing, especially in an environment where many countries did not put up countercyclical buffers, and in an environment where a lot of the public finances in a lot of countries have been depleted by past recent crises. So I will leave you with that last conclusion, which is that in the current environment, there is little fiscal space in many countries, little macroprudential space, and probably an increased likelihood that global risk appetite may decrease, and therefore that at some point risk may materialize. Thank you.
Great, thanks so much, Hélène. Our next speaker is Jay Powell from the Federal Reserve in the US.
Thanks very much, Tobias, and thanks for this invitation to be part of this distinguished panel. It's great to be here today. So today we're discussing the relationship between center country monetary policy and global financial conditions, and the policy implications of that relationship, both for the center country and for other countries affected. This broad topic has been the subject of a great deal of research and discussion in recent years, including particularly Hélène's seminal paper at Jackson Hole in 2013. And today I will focus in particular on the role of U.S. monetary policy in driving global financial conditions and capital flows. To preview my conclusions, I will argue that while global factors play an important role in influencing domestic financial conditions, the role of U.S. monetary policy is often exaggerated, or in any case had been. And while financial globalization does pose some challenges for monetary policy, efforts to build stronger and more transparent policy frameworks and a more resilient financial system can reduce the adverse consequences of external shocks. So the trilemma states, as Tobias laid out, that it's not possible to have free capital mobility, a fixed exchange rate, and autonomous monetary policy. But the trilemma does not say that a flexible exchange rate will always fully insulate domestic economic conditions from external shocks. And indeed, as Hélène clearly explained, that is not the case. We have seen that integration of global capital markets can make for difficult trade-offs for some economies, whether they have fixed or floating exchange rates. Since the Fed is the central bank of the world's largest economy and issuer of the world's most widely used reserve currency, it is to be expected that the Fed's policy actions will spill over to other economies. To illustrate this point, the scatter plot on the left side of Figure 1 focuses on movements in interest rates and exchange rates following Fed policy announcements. As you can see, changes in the U.S. 10-year interest rate after Fed policy actions, shown on the horizontal axis, lead to corresponding changes in the value of the dollar, shown on the vertical axis. And because of the dollar's widespread use around the world, these changes in the dollar affect financial conditions abroad. Fed policy-related movements in 10-year bond yields also tend to spill over to bond yields abroad, such as the German 10-year yields shown in the scatter plot on the right. These spillovers are to be expected in a world of highly integrated financial markets. As Figure 2 shows, 10-year bond yields on the left and equity prices on the right around the world typically move fairly closely together. But the influence of U.S. monetary policy on global financial conditions should not be overstated. The Fed is not the only central bank whose actions affect global financial markets. In fact, the U.S. is the recipient as well as the originator of monetary policy spillovers. For example, as seen in Figure 3, changes in German yields after ECB policy decisions also pass through to U.S. yields. More broadly, as Tobias noted, it is notable that we have raised the target interest rate 6 times since December 2015 and have begun to shrink our balance sheet, while overall U.S. domestic financial conditions have gotten looser, in part due to improving global conditions and central bank policy abroad. Much of the discussion of spillovers of U.S. monetary policy focuses on their effects on financial conditions in emerging market economies, EMEs. And some observers have attributed the movements in international capital flowing to EMEs since the global financial crisis primarily to monetary stimulus by the Fed and other advanced economy central banks. But the data do not seem, to me anyway, to fit this narrative particularly well. As illustrated by the blue dashed line in the left panel of Figure 4, capital flows to EMEs were already very strong before the global financial crisis, when the federal funds rate was comparatively high. And the subsequent surge in capital flows in 2009, which you can see, as the crisis was abating, largely reflects a rebound from the capital flow interruption during the crisis itself, although highly accommodative monetary policy in advanced economies doubtless also played a role. Moreover, capital flows to EMEs started to ease after 2011, a period when the Fed continued to add accommodation and reduce yields through increases in our balance sheet, as shown in the right panel. And more recently, capital flows to EMEs have picked up again, despite the fact that we have been removing accommodation since 2015. So if U.S. monetary policy is not the major determinant, what other factors have been driving EME capital flows? One prominent factor has been growth differentials between EMEs and advanced economies. In Figure 5, the left panel shows that capital flows to EMEs picked up post-crisis in line with the widening of this growth differential, while the slowdown in inflows after 2011 coincides with its narrowing. Another related determinant has been commodity prices, shown in the right panel. The pickup in both global growth and commodity prices over the last couple of years explains a good part of the recent recovery of capital flows to EMEs. Monetary stimulus by the Fed and other advanced economy central banks played a relatively limited role in the surge of capital flows to EMEs in recent years. There is good reason to think that the normalization of monetary policies in advanced economies should continue to prove manageable for EMEs. Fed policy normalization has proceeded without disruption to financial markets and market participants' expectations for policy. The red symbols in Figure 6 seem reasonably well aligned with policymakers' expectations, as shown in the most recent Summary of Economic Projections from our March FOMC meeting, suggesting that markets should not be surprised by our actions if the economy evolves about in line with expectations. It also bears emphasizing that EMEs themselves have made considerable progress in reducing vulnerabilities since the crisis-prone 1980s and 1990s. Many EMEs have substantially improved their fiscal and monetary policy frameworks while adopting more flexible exchange rates, which provide better insulation from external financial shocks. Corporate debt at risk, the debt of firms with limited debt service capacity, has been rising in EMEs, as shown in Figure 7. But this rise has been relatively limited outside of China and has begun to reverse as stronger global growth has pushed up earnings. All that said, I do not dismiss the prospective risks emanating from global policy normalization. Some investors and institutions may not be well positioned for a rise in interest rates, even one that markets broadly anticipate. And of course, future economic conditions may surprise us, as they often do. Moreover, the linkages among monetary policy, asset prices, and the mood of global financial markets are not fully understood. Some observers have argued that U.S. monetary policy also influences capital flows through its effects on global risk sentiment, with looser policy leading to more positive sentiment in markets and tighter policy depressing sentiment. While those channels may well operate, research at both the Fed and the IMF suggests that actions by major central banks account for only a relatively small fraction of global financial volatility and capital flow movements. Nevertheless, risk sentiment will bear close watching as normalization proceeds around the world. So the question is, what can the Fed do to foster continued financial stability and economic growth as normalization proceeds? Well, we will continue to communicate our policy strategy as clearly and transparently as possible to help align expectations and avoid market disruptions. And we will continue to help build resilience in the financial system and support global efforts to do the same. Thanks very much.
Thanks so much, Jay. I will turn to Agustín Carstens next from the BIS.
Thank you very much, Tobias, and I would like to thank Thomas and Christine, not only for having invited me to this today's event, but for having done so for probably 8 years. I think it's a very good tradition that you have kept this seminar going, because it always have added a lot of value to our understanding of key issues. I would like to start with one comment on Tobias' presentation, It really was a tour de force. I coincide pretty much with everything. Now I want to expand in the margin something that he said correctly, but I think he said it in a very telegraphic way. And that is when he presented us his chart about GDP at risk and the situation where we are. I mean, we're in the red, very deep zone. And even though I don't want to claim that we are risk-free, I just want to add that the model, the type of model he used, and Hélène made a similar comment, are conditional on having had the crisis. So they are backward-looking, and they are not forward-looking. And as Jay precisely said, and many of you are central bankers, all of you are planning to do things in the future in the direction to serve your own national objectives, but also I would think that to try to prevent a major event as we move forward, and precisely the objective of this type of panels and events are to identify the policy measures that could prevent that. So I coincide 100% with Hélène that the predictive power of these models are limited. They're good for waking us up, you know, as they did at 9 in the morning here in Zurich, but we have to put them in the right perspective. And I give credit to Tobias that he said it was conditional. So I just wanted to make that point. Another thing I completely coincide with him and with the research of the fund is that floating exchange rate helps a lot in this, in dealing with a world of very volatile global financial conditions. And in terms of the trilemma debate, but again, recognizing the seminal contribution of Hélène, my own point of view is that that really how much monetary policy leverage central banks have with respect to global factors, it has to be viewed more as an episodic thing. I mean, it's not constant. It's not like you have it or you don't. It's more like you have episodes in which the trilemma fully applies. Now, most of the time, I would say, individual countries' macro fundamentals and policies really could provide at least some degree of insulation and autonomy, and precisely those degrees of insulation and autonomy allows them to prepare themselves for a potential crisis. Now, instead of dwelling deeper into these issues of trilemma, not trilemma, I wanted to use the rest of my time to expand on a topic that we have been exploring at the BIS that works in parallel to those emphasized in the existing debate. And this has to do with the broad exchange rates of major funding currencies. And my colleague Hyun Shin will return to these issues later in the afternoon when he participates in this panel. Usually the focus is on the impact of monetary policy on bilateral exchange rates and the traditional external channels associated with this. Now, however, some of the research that we have been undertaking at the BIS has found that changes in the broad exchange rates of major funding currencies, that includes the dollar, the yen, and euro, and not in a bilateral fashion, but measured in a very broad sense against many other currencies with different methodologies, exert significant effects on global financial conditions through both price and quantity channels. And let me elaborate here. Consider a global lender with a diversified portfolio of dollar credits to borrowers around the world. Some borrowers face currency mismatch or otherwise benefit from weaker dollars. Dollar depreciation against the whole basket of currencies implies reduction in credit risk for individual borrowers, reduced tail risk for a diversified loan portfolio, reduced value at risk for some of these GSIBs, and increased lending capacity given economic capital. The broad dollar index is a proxy for a dollar debt-weighted index of the dollar exchange rate, if you want. And the existence of the above channel implies that global financial cycles should be correlated with broad US dollar cycles, as it can be seen in this graph. This graph illustrates exactly what we see in the case of cross-border bank lending flows, and I would add also securities funding. When the broad US dollar, which is the blue line, is weak, cross-border bank lending, which is the red line, is growing at a fast pace. Conversely, when the broad US dollar is strong, cross-border bank lending is stagnant. Interestingly, the relationship holds not only for lending to emerging market economies, but also for lending to advanced economies or advanced economies borrowers and lenders. This next graph illustrates something that the previous panelists have already pointed out, that the financial channel, in this case, that the financial channel of exchange rate fluctuations appear to be at work not only in the case of the US dollar, but also for Japanese yen and the euro. The negative impact of the euro exchange rate on euro-denominated lending emerged only after the great financial crisis. Now, what are the policy implications? And I end up with this. The significant impact that exchange rate fluctuations have on cross-border capital flows suggests that the financial channel of exchange rates merits more attention, not only by researchers, but also by policymakers in both advanced and emerging market economies. Funding currency central banks should factor in how their monetary policies interact with global financial conditions. A period of monetary loosening by a major advanced central bank will have a magnifying effect on its domestic economy via the impact on global conditions, which then spill back. Conversely, if a major advanced central bank is in tightening mode, there is an amplification effect that goes in the other direction. And this is caused through the, again, broader exchange rate effect. In turn, central banks in recipient countries should recognize that fluctuations in the broad exchange rates of major funding currencies can magnify international monetary policy spillovers, and they need to be prepared for this. And now, on the very specific policy measures that they can undertake to sort of prepare themselves for this, I don't have much to add other than yes, they have to use all what is available in the toolbox. No, going from monetary policy, if there is space, obviously they need to have an adequate and consistent fiscal policy, macro-prudential policies in the different flavors and fashions that Hélène and Tobias have pointed out. But I think also something that is very important as a macro, and I would consider this as part of a macro-pro approach, is to accumulate international reserves in the good times and use them in the bad times. I mean, sometimes you know that whatever comes in, at some point will have to go out, and it's better that you're prepared. And lastly, even though this is not the focus of this panel, you will have a panel for this. I am always extremely supportive and thankful for the role that the IMF helps through its contribution to the global financial safety net. So thank you very much.
Thanks, Agustín. The next speaker is Marcel from the Bank of Chile.
Well, thank you very much to the IMF and the Swiss National Bank for inviting me to participate in this seminar, and particularly in this panel. The previous presentations have made reference to the effects of the global financial cycle on emerging countries, and given that I come from one of those, I think that I can speak a little for our own experience. And in doing that, I think it's important to set the question appropriately, and I would put it in terms of to what extent domestic policies can reasonably cushion external shocks, especially those coming from the global financial conditions. So in this, I would like to stress three things. First of all, acknowledging the global financial cycle as a reality, and in the last few years there have been plenty of evidence in that sense, and Hélène's work has contributed a lot to acknowledge this. We have seen some data also provided by the IMF that is very supportive of that. Secondly, by speaking of reasonably cushioning external shocks, we are realistic in terms of seeing this as not isolating emerging economies from a globalized world, especially in financial markets, but at least in terms of gaining some policy space to limit some of the effects from external shocks. Third, by referring to external shocks, I think it's useful to distinguish between normal and crisis times, a distinction that was made earlier in this panel. And finally, by speaking of domestic policies, I would see the exchange rate regime as part and parcel of a broader arrangement of domestic macro and structural policies. So, having said that, how can we answer this question for emerging countries? So, first of all, I think it's important to note that the way in which emerging economies fit into this picture is that, given to a number of factors, basically investment in emerging economies is seen as a kind of a risk, as an investment carrying higher risk. That makes capital flows into emerging economies very much dependent on the risk appetite in financial markets. That means that our countries may be exposed to larger swings in capital movements because of that. Now, when you look at emerging economies, I think it's important to separate out the effects of global financial conditions from two other different sources of fluctuations in local financial markets. One is locally induced changes in local financial conditions. And we have had plenty of that throughout the years. In the case of Latin America, I would say that a large number of crises in the last 40 years had more to do with local policies and local conditions than with external shocks. Actually, in many cases, you could see that external financial conditions may have extended for some time an inappropriate local set of policies, but in the end, capital flows turn around with a vengeance and then crisis may be even worse. And I'm not aware of any case where favorable external conditions have helped countries to resolve major problems with the management of their local policies and or the behavior of local actors. Secondly, a second dimension or second source of changes in conditions for emerging countries are those that come from commodity markets. And many of us are, of course, commodity exporters. Some of us are exporters and importers at the same time. And even though at certain critical junctures, commodity prices may move alongside the international financial conditions, that is not generally the case. And usually commodity prices follow much longer cyclical patterns that depend more on balances of demand across different countries, technological change, and so on. It is true that at critical junctures, like the global financial crisis of 2008 and 2009, commodity prices dropped, but they rebounded pretty fast, and they continued their bonanza for 5 years before adjusting later. So I remember that at the time, at the outset of the global financial crisis, there was a lot of discussion on the extent, or a lot of praise of the extent to which, for instance, Latin American countries had strengthened their macro frameworks, but a lot of that actually came from very favorable conditions in commodity markets. So we appear to have built up fiscal and financial buffers, but a substantial part of that had more to do with bonanza with commodity markets. So separating those two sources of local changes in local financial conditions, we are left with global financial conditions and how policy regimes, and particularly exchange rate regimes, can help you deal with that. So I would say, as a country that has been floating its exchange rate for 18 years, that we can see a very clear advantage in terms of having a floating exchange rate, in terms of gaining policy space. In particular, the exchange rate regime plays a relevant role in the transmission of financial spillovers. When capital flows into emerging economies, the resulting appreciation of domestic currencies is the first line of response that discourages further flows. But in the FX adjustment, but once the FX adjustment is neutralized for countries that intervene in the exchange rate market, FX interventions basically generate pressures on domestic capital markets. So when you compare countries that float the exchange rate and those that fixed it, you would see that the response to the same external shock materializes either in changes in relative prices of our currencies or in changes in the yields especially of long-term bonds. At the Central Bank of Chile, we have produced some evidence comparing floating and fixed exchange rate regimes. I think that particularly the analysis of the response of emerging economies as compared to advanced economies to the same financial shock is very telling. And empirically, you can see that in the case of advanced economies that tend to float their exchange, their currencies, the most important impact of a financial shock is FX depreciation as compared to the case of emerging economies that see more movement in terms of term premium. Now let me come back to the issue of the role that the exchange rate plays within a broader within a broader policy architecture. Managing or having a floating exchange rate regime, of course, is not for free. If you do that, and following very much the rationale of Mandel's trilemma, you have to be prepared to face relatively large swings in the exchange rate. Put it in terms of numbers for Chile, between the end of 2014 to the beginning of 2016, we had a currency depreciation of about 50%. From the beginning of 2016 until now, we have had a local currency appreciation of some 35%. So those are rather large swings. So that potentially can make a lot of harm to the economy through major wealth shifts, solvency problems, losses in competitiveness, and so on. So this is so how to deal with this, how to deal with these effects. I would suggest a number of factors that can help you dealing with that. So first of all, it is important to minimize financial exposure to exchange rate risk. This involves minimizing currency mismatches in government, business, and bank balance sheets through regulation, call it macroprudential, and the use of market mechanisms like FX derivatives. Secondly, a deep and stable domestic long-term capital market is essential to contain the impact of external financial shocks on the flow of credit. Some countries resolve this through high propensity to save of the population. Others do it through forced savings through pension and insurance schemes. A large pool of domestic savings, particularly when they are managed by institutional investors, may need to be partly invested abroad to secure appropriate returns. In such a case, a natural hedge may develop between institutional investors and other actors, which may facilitate the development of exchange rate derivatives. Market products for exchange rate hedging may also help mitigate the effect of exchange rate fluctuations on tradables, and this may be a cheaper source of insurance than the imperfect exchange rate insurance provided by fixed rate or managed exchange rate regimes. A flexible exchange rate regime also requires to overcome the fear of floating of monetary authorities. This is especially important given the pass-through of exchange rates into domestic inflation. In particular, this requires a strong discipline in applying inflation targeting in a forward-looking mode, so as to filter short-term exchange rate-induced fluctuations. But even with forward-looking inflation targeting, the central bank may need not only to tolerate significant deviations of current inflation from the medium-term target, but also to exercise a lot of judgment in assessing when deviation in expected inflation originated in the exchange rate justifies a change in the policy stance. Tolerance to exchange rate-induced deviations in inflation is easier the higher the credibility of monetary policy. If medium-term inflation expectations remain anchored at the policy target level, the central bank can count on economic agents to help convergence afterwards. But credibility has to be built up over a number of years of consistent application of an exchange rate regime. A responsible and countercyclical fiscal stance, as was underscored by Hélène and Agustín, is an absolute requirement for consistency in the overall macro policy framework. Besides from softening cyclical fluctuations, fiscal credibility is an important ingredient for monetary policy credibility, as it alleviates potential concerns of fiscal dominance behind monetary policy decisions. Finally, all of the above may need to rely on substantial financial buffers, like moderate levels of indebtedness of all major economic actors, safe financial assets, particularly sovereign wealth funds, well-capitalized banks, strong reserve positions, and so on. So, building a reliable floating exchange rate regime able to cushion the domestic economy from financial and commodity shocks takes much more than courage or statutory decisions. it should be supported by a sophisticated financial and institutional architecture. This is not easy to capture in attribute-based scoring systems that help classify exchange rate regimes. But when this architecture is put in place and preserved over time, the floating exchange rate regime may be just the expression of a broader arrangement of institutions and policies. Perhaps it is such arrangement rather than exchange rate policy itself that one that may really protect emerging economies from major global shocks. Now, speaking of macroprudential policies, I think some of what I described may be translated into macroprudential policies, but now that we have Basel III in place, I think that we are at a very critical juncture, because the speed at which countries are adopting Basel III is not exactly the same. And when you have global banks that may have in emerging economies subsidiaries of their main headquarters, it is risky to be far away from compliance with Basel III requirements. And we have seen some of that with some of our local banks that are subsidiary to global banks that in the last few years have capitalized very little because they're building their capital base elsewhere. So I would say that this is a very important challenge. Basel III brings, I mean, to the extent that it is applied worldwide, can level that playing field, can further feed into the counter-cyclical toolbox of emerging economies. But I think we have to take this very seriously to put it alongside a number of these other components of this macroeconomic and structural architecture that can help deal with the global financial cycle. Thank you.
Great. Thanks, Mario. Our last speaker is Philip Lane from the Bank of Ireland.
Thank you, Tobias. I should, of course, qualify that as the Central Bank of Ireland is a little bit different from the Bank of Ireland, which is the main private commercial bank in Ireland.
I'm sorry.
It's a common pattern, but especially when we're on web TV, I should not claim a confusing role. Of course, I think I have three perspectives on this debate. One is, of course, as the governor of a small open economy, this is very important to us. Of course, the policy regime we have is not a national flexible exchange rate, but being part of a monetary union, which is essentially a hybrid solution, which is it's de facto a fixed exchange rate with our fellow members of monetary union. But of course, we're all part of a global financial system. Especially a country like Ireland, which has very deep connections to the US and UK financial systems. And then, of course, I'll put on a third hat, which is as someone who's spent quite a while thinking about financial globalization from an academic perspective. So I think today's topic has been very well chosen, and I think what this panel has arrived at is a pretty high degree of convergence. And the convergence is towards a point where the answer is nuanced. So we cannot have kind of one-sentence summaries like dilemma, not trilemma. We're all agreeing that it's a very nuanced situation, which of course is why the work of the IMF, the work of all of our national institutions in continuing to work on this topic is so important. Let me emphasize a few things. Is the global financial cycle sounds very intuitive. It sounds, everyone I think feels it. This is a real concept. We know what it felt like before. We know what it feels like. But let me emphasize is that history doesn't exactly repeat itself. There's an underlying common thread, but it's never quite the same. And the conditions we had in the mid-2000s I don't think we're going to face again because, first of all, we've learned some lessons in terms of building up resilience and so on, changing the regulation of banks. But I think in the mid-2000s, we had a very unusual situation, which is such a large fraction of the world economy was essentially tracking US monetary policy. So, of course, here the US is a large economy, but you had various countries in emerging Asia which didn't want to tolerate too much by way of exchange rate movement against the dollar. It's unlikely in the future we're going to have the same situation. So one of the messages I think we heard several times this morning, which is global financial conditions are determined by many factors, including the monetary policies of the major central banks. But over time, especially as China takes on more and more of a flexible exchange rate and more of an international currency status, that's going to really broaden out. I mean, recall also in the mid-2000s, if we talked, without having the language of global financial cycle, the language at the time was of the global savings glut. So the impact of the reserve accumulation, the impact of the search for safe assets on the financial conditions in the US and in Europe. So we know, and Jay's presentation also had this, that if you go beyond policy rates to 10-year rates and so on, there's a lot of global influences there. European investors affect the US conditions, Chinese investors affect conditions everywhere, and so on. So unfortunately, the global financial cycle is not a stable physics kind of concept. It's something that's going to move over time depending on multiple factors. Let me also emphasize here that we also have to think about, well, what is it exactly? Is it the availability of central bank funding at whatever the central bank is providing to its counterparties? What are the liquidity policies? Is it global risk appetite? Is it the fact that more and more there's global investors with a similar portfolio, and so their wealth dynamics are moving in a similar way? Or is it simply going more deeply into the global economy, global value chains, and so on, that all of our GDPs have a common factor, which is increasingly important? So here, I think the risk appetite element remains a little bit mysterious. I can remember in discussions of the Asia crisis in the late 90s, Rudy Dornbusch used to refer to the CNN effect, which is basically we're all getting panicky by watching the same global news programs. I'm not so sure now what the corresponding Twitter feed is. Maybe it's Hyun Shin's Twitter feed, but let's see, which is propagating the global risk appetite around the world. But I do think we have to think about that because, again, all of those are relevant, and thinking in a given episode what is going on, I think, is very important. So this is a little bit like Agustín. We can't be captured by past data. We have to think about what's going on, which I guess keeps us all in a job, because that's our job, is to think about these things. Let me emphasize also is coming back to the Trilemma framework. Remember, Mundell-Fleming, which is a classic great model to think about, is a flow model. So the interest rate is a sufficient statistic for financial conditions. Now, as Mario was just talking about, you absolutely need to have a balance sheet approach. You need to have, for monetary policy to be effective for an emerging market, your FX exposures have to be well managed in terms of not being too short foreign currency for monetary policy to have perverse effects. And I think that's also true when we think about advanced economies, small advanced economies. I guess this is part of when you move to using non-conventional monetary policies, a lot of this is about managing the balance sheet of the central bank against counterparties. So this is coming back to the monetary policy and financial conditions. Monetary policy has an effect on those parts of the financial system most directly exposed to the actions of the central bank. But other parts of the financial system may be more immune. So, for example, right now, when you read various financial stability reports, commercial real estate is an issue, where those who are involved in investing in commercial real estate globally, or at least in many places, are probably a common set of investors coming from different countries and different regions. But essentially, their funding mechanisms, a lot of equity, a lot of private equity, a lot of, say, family foundation money, is not maybe super exposed to monetary policy, which typically is going to really act on those who are most leveraged in the economy. So, I think you can have different global financial cycles. What we're seeing now, I think, in financial stability risks is not what we've seen before. And the toolbox is not necessarily the same. And this goes to, I think, some of my fellow panelists have emphasized macroprudential and fiscal. And macroprudential, I think, is desirable and helpful, but it doesn't get everywhere. Now, to some people, if it doesn't get everywhere, the temptation is to say, well, let's use monetary policy. But monetary policy is pretty costly to use because we know it has a big effect on the real economy. So there are fiscal options. And there, let me emphasize, it's moving beyond the budget balance. It's also using tax rates in a selective way. So one of the discussions during the crisis in Europe was, well, are there fiscal equivalents to an exchange rate devaluation? So fiscal devaluations was a topic. But there may be fiscal equivalents to interest rate movements in relation to financial stability. So recently, commercial real estate in Ireland has been quite active. And at the end of last year, the Irish government raised a transaction tax on commercial real estate. Now, the motivation there had different motivations, but definitely in terms of being an effective way to alter the direction and composition of capital flows, those kind of tax rate measures can be quite important. So the menu where we say, well, there's macroprudential, there's capital flow management, I mean, an integrated analysis, I think, also needs to say, well, what kind of tax rate measures may also play a role? So I think at one level, I think we're converging on this panel to some extent in terms of identifying the set of issues. But I do think actually the work here is far from done. I mean, the work in the last number of years has been very helpful, but really identifying optimal policy responses, I think there's still a lot to be done. And I do think, given where we are now, where we need monetary policy in many countries to be accommodative, because the recovery from the crisis is far from over. On the other hand, we need to use macroprudential, but where macroprudential doesn't reach everywhere, we need to think about using fiscal in an effective way for managing these financial risks. So let me stop there.
Great. Thanks so much, Philip. So your last comment about lots of work remaining to be done is a very good concluding comment for the panel. This has been fascinating. I would like to thank the panelists for really insightful comments. This has been a great debate, and it's going to be a good basis for having a coffee break for the next 20 minutes until 11. When we will reconvene for the second roundtable. Thank you very much.